Countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. Starting the next quarter with perhaps a bit of softness. You're seeing the NASDAQ leading the declines lower 0.7%. S&P off by just 0.1%. Really, the Russell 2000 gaining about a quarter of a percent, given the fact that the small, regional, and bigger banks are all doing well, given the fact that we did not get any news over the weekend about banking crises, so perhaps banking crisis over. In the other space, we're seeing yields higher on the heels perhaps of what happened with OPEC Plus cutting production by more than 1 million barrels, crude prices up by more than 5%, almost 6% on the NYMEX. Same with what you're seeing over with respect to crude, and a little bit of dollar weakness pretty much across the board. OPEC really leading the charge this morning, delivering a surprise production cut as Q2 gets underway, setting crude prices higher, which we just saw, sparking a rally as well in energy stocks following somewhat brutal month for the sector that we just saw. For more, Abigail Doolittle. Abby.
Yeah, big gains there, Lisa, for some of the big oil companies today. And it's interesting because oil, you were mentioning the rough month. It's actually been a rough 5 months for oil, down 5 months in a row, the longest losing streak for oil going back to 2015, as traders really assess what's going on coming out of the pandemic. Of course, we had that supernatural rise, plus the inflation pressures. But right now, oil is, of course, popping up more than about $5 for both WTI and Brent crude. And technically, we have oil set to go back toward $90. This is a very reliable range. Oil now back above its $50-day moving average, going toward the yellow 200-day moving average. That's a fancy way of saying the long-term traders may get more reinvigorated here. In fact, some analysts are saying that because of this OPEC Plus cut, that it puts $100 per barrel back on the table, as we saw last year. Now, interestingly, even as we've had oil on the decline over the last several months, that has not been the case for big oil. Some of these companies really figuring out how to manage it. If oil does increase, Lisa, it seems pretty clear that it could go right to the bottom line of some of these big companies. One reason that we do have some of these big oil names higher, and energy right now up 3%, the best sector on the day.
Abby, thank you so much. Meanwhile, over in the merger sector, you're seeing something different for WWE, that is World Wrestling Entertainment. Shares falling after Endeavor struck a $9 billion deal to buy the firm. The CEO is saying, quote, given the incredible work that Endeavor has done to grow the UFC brand, this is without a doubt the best outcome for shareholders. Let's bring in Bloomberg's Katie Greifeld for more, evidently the WWE expert. Katie, why is this not perhaps getting the most enthusiastic response from shareholders?
Well, Lisa, let me just start and say that this is huge news in the world of televised combat entertainment, which I learned a lot about this morning. So the combined company, it's going to be valued at more than $21 billion. And like you said, Vince McMahon came out and said this is without a doubt the best outcome. But you do see shares falling right now, currently off about 7% or so, because the counteroffer is seen as unlikely. Those are the words of Wells Fargo. So that could explain the reaction that you're seeing in the shares. Let's get into the numbers, though. Endeavor is going to control 51% of this new company, and Ari Emanuel will take over as the CEO of that new company. And this deal, it values WWE at about $9.3 billion. Wells Fargo, again, said that the reported bid implies an offer price of about $102 per share, which WWE, it's never seen that number. If you look at a long-term chart of this stock, the all-time high is just below $100. That was reached in April 2019, and we had been getting closer. Shares closed at about $91 on Friday, but as you can see, with today's plunge, currently now off about 9% or so, we're back below $84.
Katie, our televised combat expert, thank you so much. Turning now to technology, Tesla's first quarter deliveries falling short of Elon Musk's goal, even though they did come in at a record. Shares following down after a host of price cuts led to a record quarter for the stock. Bloomberg's Ed Ludlow joining us now from San Francisco. Ed.
Yeah, good morning, Lisa. Both Tesla and Rivian, its kind of plucky rival, lower in this early exchange of trading. Actually, Rivian now flat, modestly higher after both of their first quarter deliveries beat expectations. For Tesla, 4,222 vehicles. Above street expectations, but as you said, it isn't enough to keep them at that 50% annual growth rate that Elon Musk has talked about. This was a fresh record, and you can see that it is also a gain from the prior quarter where output had been ramped up. The concern the street turns its head to is margins, because this was a result of price cuts that Tesla had done in multiple jurisdictions, including the United States and China at the beginning of the year. You'll remember that Elon Musk talked about demand running at twice the rate of production in those early weeks of 2023, directly stemming from that price cut. The other data figure that we look to, though, or data point that we look to, is that this was the fourth consecutive quarter for Tesla where production exceeded deliveries. Once again, Tesla talks about a high number of vehicles, particularly Model S and Model X, being in transit at the end of the quarter as the company moves to a more even mix of production across its factories in multiple regions, the United States, Europe, and China. But shares a bit low. You have to remember the run-up in the stock this year, above 60% after what was a difficult year for the stock in 2022.
Ed Ludlow, thank you so much. Meanwhile, the warnings for Wall Street are piling up. Chris Harvey of Wells Fargo delivering the latest one, writing, quote, "The first quarter will be one of the most unforgiving earnings seasons in some time. It is still difficult to identify the most at-risk companies, but the more cyclical firms could see some of the bigger penalties for EPS weakness." Chris, I am so pleased to say, is joining us now. Chris, let's start there. Why haven't we seen such a real punishment from some of the earnings misses, which we actually did see during the first quarter?
Lisa, that's a great question, and we're not sure. But at the end of the day, what we're in a slowing economy. We're staring into a recession. The Fed is not going to bail you out. The economy is not going to bail you out. And if you can't make numbers, it's going to be a very, very difficult period. And it's going to be a very difficult year because typically we see serial correlations with these issues. We haven't seen this big pain, but typically before a recession or before a big slowdown, this is when we start to see things really change. And again, there's nothing that's going to bail you out at this point in time. Not the economy, not the Fed. And at the end of the day, it's going to be a very, very difficult season for some companies.
So this is what people thought in the first quarter as well. This is what heading into 2023, the likes of Mike Wilson were saying over at Morgan Stanley, and it didn't come to pass. People say that things kind of hung in there when it came to earnings. Not that much. Right. Actually, they weren't that great. Morgan Stanley's Mike Wilson just doubling down over the weekend, saying we see little evidence that a new bull market has begun and believe that the bear still has unfinished business. So he agrees with you, talking about tech's relative outperformance as really just hinging on the potential for stimulative aspects of the bank assets, which Federal Reserve assets have grown, but he really pushes back against that. So from your vantage point, what will be the key moment, Chris, where people kind of realize that weakness actually means weakness?
Yeah, so a couple things there, Lisa. The first thing I would say is for the last few quarters, we haven't had this stance, right? We think there has been more fear-mongering than fact. But now what we have is we had the banking stress, the banking crisis in the middle of the quarter. What we're going to find out, what we're looking for is what companies say. Do they say things were good up until the middle part of March and then things slowed down, right? So if you go back to fourth quarter of 18, right? A lot of companies said, hey, we read the newspapers, we see what's happening in the stock market, but the consumer, our end markets were still strong. I'm not sure that's true anymore because you do have a much tighter Fed. We are long in the tooth at this point in time, and you do have real concerns on the funding markets. And the last thing is we have been seeing for a number of quarters margins starting to compress, and we think this is where it comes to roost. This is the period where you really have to, if you can't make numbers, if margins get compressed, this is where you get penalized. And this is the first of what may be several very difficult earnings seasons.
Chris, let's talk some tail risks. Is the banking crisis over?
The first thing I would say is we think the overall bank industry is very solid, very stable, okay? We think that things are very regionalized and probably could have used a better word, but the regional bank situation has stabilized, but there's still some idiosyncratic issues. We are going to see some of that play out during earnings season, but overall the bank situation is in good shape. And the the Treasury has a good job at backstopping things, and things have calmed down. But I don't think that the thing that we're facing and the thing that we fear the most and the concern that we have is we've crested on liquidity. Access to capital will be a little bit more difficult to come by in the second half of the year, and that's going to have economic effects. But overall, the bank space is still in a good space. The banking sector is working. We expect it to continue to work. This is not the great financial crisis by any stretch of the imagination, but there are parts of the banking space that still need some that are still under a bit of stress.
It's especially under stress because rates are so high and people are taking their money out of deposit accounts and putting it in money market funds, which we've seen see record inflows. To what extent do you see some sort of reduction in credit, this sort of credit tightening that everyone's expecting and eager to get on May 8th with that senior loan officer survey? How much is that going to really cap how far the Fed can raise rates and even cause them to cut?
Yeah, so again, a couple things there. If you look at the senior loan officer survey, we've already seen conditions tighten, and this is before SVB. So you would have to believe that conditions are going to tighten even more, or somewhat more, as we go forward in time. Right? What does this all mean? This all means that we're going to have more friction, that the liquidity that we had over the past couple of years, you can't rely on that anymore. And what that means is that risk, for the most part, is probably not priced correctly, and we're going to have to see a repricing of risk because of different liquidities. And the last thing I would say is you are hearing from the powers that be that we probably need more regulation in the banking space. Regulation and liquidity don't usually go hand in hand. What they're talking about is, for some companies, raising liquidity, raising capital, and that's going to have an impact on the availability of credit. If you're good credit, you still will be able to get it, but at the margin, it's going to become more difficult and risk-based capital will become more costly.
So isn't this just an argument for big tech? And a lot of people are pushing back right now, saying that it's not necessarily interest rate sensitive, but if they already have sold off somewhat, if there are definitely efficiencies that are getting sort of bled out, and these are not companies that are going to struggle to get credit, are they sort of defensive stocks right now?
Yeah, Lisa, so our price target for the S&P 500 is 4,200. It's 20 times on 210. The reason why we got there, and those are pretty healthy numbers, but what we were saying at the beginning of the year is we think rates will come down. This will be a good environment for growth. The economy will slow down. That's also a good environment for growth, and the S&P 500 is a growth index. And so the answer is we've wanted long duration. We thought growth would come back. This is the environment that growth does come back in. But what we're seeing too is we're seeing some of these longer duration assets really run up in the short term. We do expect to see some pullback. The place that we think that's lagged a little bit, not a ton, but a little bit, is mid-cap growth. And that's a place where we want people to put new money to work.
Chris Harvey will be sticking with us. Coming up, we'll hit oil. OPEC's cut stoking U.S.-Saudi tensions.
It was definitely designed to boost oil prices. I don't think we're staring in the face of 100. We're certainly flirting with a market which could see more demand in the spring and summer.
That conversation still ahead.
Well, we're coming back now with a report on the S&P Global U.S. Manufacturing PMI. It's a slight tick down to 49.2, which is just below 49.3. Statistically meaningless change, but it does suggest that manufacturing is still not picking up in the United States. Same story in Europe, where we saw most of the countries over there, the biggest economies, also in the 40s for their manufacturing PMIs. Question now becomes, how does the ISM turn out at the top of the hour? We are expecting at this point a 47.5, which would be down a little bit from 47.7. That'll be the big number to trade on today.
Michael McKee, thank you so much. Tension simmering, meanwhile, between the Biden administration and OPEC Plus after a surprise production cut, Saudi Arabia leading the way by pledging its own 500,000 barrel a day reduction. The White House calling the move ill-advised and vowing to focus on lowering prices for consumers. Bloomberg's Anne-Marie Hordern joins us now with more. Anne-Marie, do we have a sense of what the administration's response is likely to be?
Well, they said it's ill-advised, and Lisa, this surprise cut over the weekend, Sunday surprise from OPEC, was a little bit of Sunday scaries for the Biden administration. What RBC's Halima Cross has said is that obviously these Gulf producers, they are pursuing their own economic interests, but the Biden administration has their own interests as well, and that's keeping a lid on oil prices and gasoline prices. What we could potentially see is they could tap the SPR again. Remember, they have been making this historic taps of the Strategic Petroleum Reserve, trying to make sure they can quell an oil price rise that was inflicting on gasoline prices as Putin was invading Ukraine. The other thing you may see, and this would be a lot more political posturing, but there is this NOPEC bill in Washington. And what this would allow basically the United States to do is go after countries that are part of this cartel, even suing them. Now, I'm not saying this is going to get past the finish line, but when you see movements like this, these are the kind of conversations that start to come up to the surface.
Anne-Marie, just quickly here, some people would say that perhaps the U.S. thinks too much of itself in this particular case, that perhaps this is really just catering to China, and it's quite clear in Riyadh that China isn't going to have the same kind of demand for energy that it was perhaps before we really got a sense of what the reopening would look like. How much credence do you give that kind of line of reasoning?
To be honest, I do really believe this is Gulf producers looking out for their own interests. When you look at especially what's going on in Saudi Arabia, obviously no OPEC minister will come on or leader will say that they want higher oil prices, but they'll say they want a supply and demand. But clearly this benefits their economies. Also, when you look at what's going on in the kingdom right now, they obviously took a huge hit when it came to the collapse of Credit Suisse. So I truly believe this is more about their own economic interest than trying to play this hand to China.
AMH, thank you so much for being with us. Chris Harvey of Wells Fargo back with us. Chris, how much does it change the game that OPEC Plus is cutting production by more than 1 million barrels a day?
I think it really does. And now the question is, what the Saudis look like they're doing is they feel like they have leverage. And now this is going to create a back and forth. But at the end of the day, I agree with the other commentator. They're looking out for their best interests, right? And one thing that came out recently is if you look at energy production in the United States, 20% of the electricity production in the United States, 20% of it is from renewables, which is, I believe, slightly more than coal. That is something you couldn't imagine 10 and 20 years ago. And so the hydrocarbon space is under pressure, it is under attack, and they're going to do what they think is in their best interest, which may not be aligned with our best interests and our consumers.
Well, Chris, do you take from this that oil prices are going to be higher, or do you take from this that perhaps growth is slowing more substantially globally, and that's going to feed back into other inputs as well?
And Lisa, let me just talk about a big picture. What we think that we're going to have higher lows and higher highs because in the United States, there's a disincentive to invest in supply. And that's going to create a difficult situation. The only thing that's going to change is price. And so we're going to have a situation where the lows aren't that low and the highs continue to march higher overall. As far as the short term, that's hard for me to tell. But overall, because of some of the supply issues, some of the incentives, and some of the policy, you're just not going to have the supply that you want that's going to bring down price the way it has in the past.
So, Chris, are you bullish on energy companies just in general? Do you think that those stocks still are really going to be the ballast?
So right now we're neutral on energy. We are looking at the pullback. There are a lot of really attractive companies in the energy space. The energy companies have done a fantastic job at restructuring their balance sheets, at doing shareholder-friendly activity, and we think there's a lot of value and a lot of quality there. The one issue that we have is we do think we're going into recession. We do think things are slowing down. So it may not be tactically the opportune time to get aggressive on energy just yet.
How different is your outlook today than it was, say, at the start of the year when it comes to what's defensive and what's not?
Not too different. So at the end of the year in December, we did downgrade some of the staples because we thought valuation wasn't that attractive, and what we thought was going to be defensive sector-wise was pharma. Because of valuation, because of the underlying fundamentals. We also thought that better balance sheets would be more defensive, and we remain in that camp, and actually we think that's the place that you really want to be. And one of the things I think you're implying is what you're seeing in the marketplace is Uber caps or large cap growth or technology appear to be the new low vol, and to some degree we understand that. But it's also because when you're in a banking crisis, when you're in a situation where there's stress, you want to have those better balance sheets, you want to have those stable growers, and people have run to that. But it does look like that's a little bit stretched in the short term. But overall, those balance sheets do look pretty attractive to us.
On the flip side, do you fade some of the home builder stocks?
It's not so much we fade the home builder stocks. What we're fading is we want to fade risk, we want to fade cyclicality, and we like growth or GARP over value. We think we're going into a slowing economic environment where credit is going to be more difficult to fund, and we're late in the cycle. And here's the thing that we keep coming back to, right? We're close to our near-term price target. As we look forward in time, it's heads we lose, tails we lose, because financial conditions in all likelihood are going to tighten. They're either going to tighten related to the banking crisis or the banking stress, or they're going to tighten because we've resolved that, it's in a good place, and the Fed will get back on its horse and start raising again. And so we're looking at a situation where financial conditions almost no matter what tighten, and that's just not a great environment for risk and risk product.
Chris Harvey, thank you so much for taking the time. Have a great week. And now let's take a look at some of the sector action. We've seen a lot in the energy stocks. Abigail Doolittle on deck. Abby.
Hey, Lisa. Well, of course, energy is the top sector on the day, up more than 5%. A really classic risk picture here. We do have small gains on bottom utilities along with some of the tech companies as yields go higher. Relative to energy, it's a 7th up day in a row, the longest winning streak since last October. And we also have, today's 5% pop, the best day since last October. That streak, the best since last March, Lisa.
Abigail, thank you so much. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary.
Stay like Bloomberg.
This is Bloomberg The Open. Let's take a look at what's going on right now. About 25 minutes into the session, we see the Russell is actually gaining the most, up 0.3%. S&P up 0.2%. Still in the red for the Nasdaq, perhaps on the heels of some of the increase that we're seeing in yields, down about 0.5%. Time now for the trading diary. What you need to be watching this week: ISM manufacturing coming at the top of the hour. President Biden discussing his economic agenda for Minnesota at 2:30 Eastern. On Tuesday, Credit Suisse holding its annual shareholders meeting, plus Fed speak from Cook and Mestard, followed by Bullard on Thursday. And finally, on Friday, yes, it's Good Friday, but it is also the main event, the U.S. payrolls report to close out the week, with potential perhaps for a softening, but not that much. People still, Citigroup among them, expecting more than 200,000 jobs created. This was Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, April 3rd. Here are the top market stories that we're following for you at this hour. The OPEC Plus surprise. The cartel promises to remove more than 1 million barrels of oil a day. Oil rises over 6%. And the reflation problem. We're going to try to find out, if oil is headed towards $100 a barrel, what kind of inflation problem does it pose for central banks? And we get the latest read on economic data with Tim Fiore, chair of the ISM Manufacturing Business Survey Committee, just at the top of the hour. And WWE's stock smackdown. Endeavor buys World Wrestling Entertainment to form a new company valued at more than $21 billion. WWE stock is down 4%, but off the lows of the session. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Now, Guy, it feels like OPEC really threw a wrench now into all the economic data that we're going to get this week.
Yeah, certainly into a lot of people's calculations. Where are we going with the oil price? I think is a big question now. And is that going to slow the U.S. economy down? Is that an inflation fear that we should now factor in? There's lots of things to think about there, and we need to do that, and we will do that. But first, before we do that, Alex, we should get to the data because the ISM manufacturing number has basically been signaling contraction since November, and we get a soft print today, bottom of the range in terms of what we were anticipating. The headline number comes in at 46.3. That's down from 47.7. The survey 47.5, and then you work your way through it. Prices paid now below 50, 49.2. Employment 46.9, which is a big drop that's worth paying attention to, down from 49.1, and new orders 44.3. That new order slowdown, again, Mike McKee, is something that we want to be looking at fairly closely. What is your read on this data?
Well, it does tell the story that the U.S. economy seems to be slowing down, but I'm not sure how strong of a story it's telling because we knew manufacturing was already slowing. It'll be interesting on Wednesday to get the services data, but as you point out, with new orders down and with employment down, it sets up an interesting situation for Friday when we get the jobs report. Does that mean that we're going to start to see the slowing that everybody has anticipated? And of course, prices paid, we would normally be celebrating the fact it drops below 50 in terms of the Fed's inflation fight, but now with the oil price shock from OPEC, it's going to be interesting to see whether it holds that way.
Yeah, great lead-in because you spoke to Jim Bullard about many things, but in particular when it comes to the inflationary scenario and oil price.
Yeah, Bullard has been one of the more hawkish members of the committee, and he's suggested that rates need to go to 5.6% because inflation is going to be sticky. However, I did ask him this morning about the oil price shock, and he's not as concerned about that as you might think.
This was a surprise, the OPEC decision, but whether it will have a lasting impact, I think, is an open question. Oil prices fluctuate around. It's hard to track exactly. Some of that might feed into inflation and make our job a little bit more difficult.
Of course, it's always difficult for the Fed to react to energy price shocks because they don't react to interest rates. And so the question will become, does that feed through into other areas of the economy? When we talk about the manufacturing area, of course, energy plays a big role. And then will that feed into consumer psychology? Because does this mean that gasoline prices will go up? Or as Jim Bullard suggested, maybe what happens is we see prices adjust back down as the market starts to consider both supply and demand.
Yeah, Mike, thanks a lot. Really appreciate it. Thank you so very much. And Guy actually pointing out that yields are now down on that ISM number. They were up earlier on those reflation fears from the oil price. Mike, good stuff. So let's get more on these numbers here. Tim Fiore, he runs the ship over at ISM Manufacturing Data. He joins us now. Hey, Tim, walk us through the demand side of this.
So disappointing for sure. I mean, I think we were hoping to see a bit more of a recovery consistent with the month of February, but we didn't get that. So all 10 sub-indexes of the PMI were sagging. They're all in contraction territory, several of them in fairly moderate territory. The demand piece is concerning. We had customer inventory levels about right. We had backlogs sagging again close to 40. New export orders came down again, and the new orders number came down. So I think it's a clear sign here that we're in for a period where we're going to see pretty weak demand for the next 3 or 4 months, unfortunately.
Tim, good morning. It's Guy. Are we finally at the point where these manufacturers are also going to start laying people off?
So we did have a shift in the month of March. We definitely saw nearly a 1-to-1 ratio between the companies that were hiring and the companies that were managing headcount down. That's a fairly significant shift from the 2-to-1 that we've been pretty much working on for the last 3 or 4 months. So, I think people are getting ready to kind of de-staff a bit. Right now, the majority of it's being done through attriting down and hiring freezes, but there is a significant amount of layoffs being noted. I track 5 or 6 main elements to see when the manufacturing side is going to really convert. And of those 5, only 1 is in positive territory, and that's really the lead times. The lead time numbers in the report, the data don't support fully a reduction, but comments from the panelists are indicating that lead times are coming down, which really says the suppliers have capacity and they're trying to fill their order books. But the demand just really isn't there, and people are still working off their backlog, which is really overdue, and it's a bit unfortunate. So the demand side is definitely weak, and it likely will remain weak for some months to come.
So some months to come, is that like a good or bad weakness? I know that might be a silly question, but is this sort of tentative buying and just everyone's kind of holding to see what the economy does, or is it significant, or is this pointing to a significant slowdown here?
No, I think it's the former. We've been working off over ordering for the last 9 months. I think we've pretty much worked that off. So now we're trying to refill the order books, but people are reluctant to do that because they're really not sure what the future looks like, primarily because we've been raising interest rates and it's been slowing things down. So I think manufacturing companies are pretty much hunkering down now, and they're getting ready for a slower period here for sure.
That said, Tim,
so,
do you get?
Yeah, so
sorry,
let's just
carry on.
Let's just kind of point something out here. We've had about 5 months of steady sagging. I think Mike started off with October being at the 50 level, but we've only sagged 3 or 4 points. It's been a very slow slowdown, which is the positive side. But if you're a growth and demand and profitability focused perspective here, this isn't a good report. If you're looking for the manufacturing economy to slow down, which really is a precursor for the entire economy, then you're pretty happy with this report. The interesting thing on the pricing side is that it pretty much says that we're stable. We're at a stable level. So we haven't gotten back to where people wanted to get back to. But if you look at the last couple of months, we've been hanging around 49 to 51. So that pretty much says that we're pretty stable on the price side. And Mike's comment here on energy, we'll see what that means. On the manufacturing side, there's no indications that transportation costs are going up, but we'll see what the energy side does to that in the next month or two.
Okay. So you take us there. So let's go there now. Tim, our question of the day is, are we heading back towards $100 a barrel? If we go back to $100 a barrel, how does that change the narrative you just described? If we do see transportation costs going up, if we do see diesel rising, these are factors these businesses are going to have to bear in mind potentially fairly quickly.
Yeah, for sure. And I watch the chemical sector very closely because it's a feedstock pretty much for the other 17 industry sectors. We're still sagging more in the month of March and February. We're still not at 45 or below. I have been reporting to your listeners that I'm really watching the industry sectors that are 45 or less. And in the month of February, only 10% were 45 or less. In the month of March, 25% were 45 or less, primarily driven by food and beverage. But we'll see what happens. I'm not expecting a huge run-up in feedstock costs, petroleum products costs, but we'll see what the future brings on that.
Yeah, but Tim, you mentioned that pricing is now stable, and I'm wondering if now pricing gets a little bit more unstable because of it.
Well, it's stable on the high end because, we never got back to where we really wanted to be. We're significantly higher than we were pre-pandemic. And as I mentioned last month, the steel markets, the copper markets, even the aluminum markets are showing signs of strength again. And in the month of March, the same thing occurred. So I'm not expecting a lot of relaxing on the pricing side. So if you're looking for inflation to come down, we're not showing it here.
Tim, is it time for the Fed to stop hiking rates, or is it time for them to start considering cutting rates?
Well, they're trying to get to a 2% level over time. I'm not sure that we're actually on that path yet, but it's a slow time delay. The only thing I can point out here is throughout this hiking, we've slowed on the manufacturing side, but not dramatically. And the manufacturing PMI is highly cyclic, and we're not really cycling here. Like I said, we've only had a 3 or 4 point decline since October of last year, which is pretty weak.
Yeah, that is worth bearing in mind. And it's interesting to see the delta change here in terms of the rate of change, maybe a little bit. Tim, great to see you. Always a pleasure. Instant analysis on your numbers. We so much appreciate you doing this for us. Timothy Fiore, Chair of the ISM Manufacturing Business Survey Committee. Coming up, more on our question today. We're going to take you back to what is happening with oil. Are we heading back towards $100 a barrel? We're going to ask Anne Miletti, Head of Active Equity at Allsprings Global Investments. That conversation is next. This is Bloomberg.
Bloomberg has the Fed coverage you're looking for. Wednesday, an exclusive interview with Cleveland Fed President Loretta Mester.
I do believe we have more work to do.
For all your Fed coverage, keep it tuned to Bloomberg, your global business authority.
Higher oil prices push up the headline CPI number, but they are fundamentally disinflationary for the U.S. economy because they take money out of the hands of lower middle-income consumers, and they will just spend less on other things. So if I were in the Federal Reserve's position here, I would not look at higher oil prices as a reason to get tighter. It's actually a reason to get easier.
That was David Kelly, JP Morgan Asset Management Chief Global Strategist, talking on oil and the Fed earlier on Bloomberg Television, which brings us to the question of the day. $100 oil? A, do we see it? And B, what are the kind of bigger ramifications here? Ann Maletti, Allspring Global Investment Head of Active Equity, joins us now. Ann, $100, do we see it?
If we see it, I think it's only going to be for a very short time. I think OPEC's taking an outward look, and I think they're looking at where is demand really going to come from. Yes, we saw the reopening trade in China. Yes, things have been a little bit better in Europe. They've been better here in the U.S. But is demand really going to strengthen from here? And I don't think they believe it is. And so that's probably why they chose the production cuts.
And let's put this together with the ISM number. So David Kelly talking about the idea that this is actually going to be a further factor that's going to slow the U.S. economy down. You've just seen an ISM print on the manufacturing front that certainly points to a manufacturing sector in the United States that is continuing to slow down, maybe picking up the pace a little bit. What does that tell you about where we are in the cycle, how close we are to the end of the Fed hiking rates, and what does that mean for investors?
I think we are closer to the end of the cycle, and we're starting to see real pressures. Certainly the manufacturing data has been soft, and it continues to get softer. Everybody looks at the services sector and says, well, that's what's been holding it up. But I'm not sure how long the consumer is going to be able to do that. Certainly the increase in rates has put pressure on the consumer, and I think it will continue. I know the labor market has been strong. We'll see if it can continue to be strong. But I think, again, things are breaking in the system, and it's going to cause real problems with the economy going forward. And so that changes our outlook. I think it makes it feel like, again, it's going to be hard to find real upside in the economy. There's going to be more pressures on the downside.
But, on the other hand, we were talking to Tim Fiore just moments ago, and he said if you're looking for inflation to come down, this is not the place to look. And then if we couple higher oil prices, and even if we don't get 100, there's clearly a floor, and that floor looks to be 80 for OPEC. So that needs sort of a readjustment and a rethink. How can the Fed back off if inflation's not going to be coming down?
Well, it is. It's this yin and the yang, right? I mean, OPEC for sure doesn't want to see really low prices. And, we've known that for a long time, so they do what they can to protect. But I do think we have kind of one, very important part here in North America. We do have the ability to drill and produce our own oil. And so we can turn that spigot back on. I think the oil producers here also, don't want to do it. They won't do it if they can't make a profit on it. And so they'll want to see oil above $70 to be able to do that. And so we'll see this, pressure on oil to stay a little bit higher, but I think we can keep it, below 100.
Yeah, maybe that's the message from OPEC. If you want more oil, maybe you should pump some. And what does this mean in terms of what I want to own in the equity market? Do I go back to the oil stocks on the back of this? How do I rethink my equity strategy?
Well, I do think, you have to be selective. And, even within energy, this might be just a short-term trade. So if you're going to go into energy, you want to be very, very selective on the stocks that you go into. Strong balance sheets, strong free cash flow, and very disciplined management teams, whether it's in energy or in any other sector. That's what our investment teams are looking at right here in the later part of the cycle. Even if we go into recession, there will be pieces in the equity markets that can outperform. But investors are going to be looking for secular stories, not cyclical stories, and stories that can outgrow the market.
Does that include tech or no?
I think you can't kick tech out of that because technology, companies are going to look for productivity improvements, things that can help keep their margins and actually improve their margins. And technology companies have been known to do that. And so there will be technology investments that will make sense for investors. It won't always be the big technology companies, but certainly some in the mid-cap space and even in the small-cap space.
What do I do? How do I sort of think about my portfolio from a cash, bond, credit, equity point of view? How would you sequence those out at the moment? What should I be doing? Is this a signal today maybe that the yields are going to be going lower, that I should be maybe emphasizing my bond portfolio? You talk about you can find areas that are going to outperform the index in the equities, but that's going to be tough. Where is the easiest trade to make right now, Anne?
Look, I'm an investment, I'm an equity person, right? That's where my expertise lies. But here at Allspring, we do believe that bonds are back. And you are going to get some real return from the fixed income market. And, again, I'll leave it to our experts on the fixed income side to talk about where, but I do think investors are looking more at the fixed income market than they ever have. It's been the first time in a decade where you can really look at getting a good return there. And so I think investors are looking at all areas where they need to be positioned in cash, fixed income, and in equity. I just wouldn't sell your equity portfolio because as we've seen already this year, you have to be right twice if you're going to sell. You have to know when to sell and you have to know when to get back in.
Often the latter, the more tricky. And great to catch up. Thank you very much indeed. Anne Maletti, Allspring's Global Investments Head of Active Equity. Still ahead, Tesla reporting disappointing first quarter deliveries. That's taking down EV rivals like Rivian and Lucid today. We're going to dig into the details next. The startup is coming. This is Bloomberg.
Great questions.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Lisa Mateo. Extra Space Storage has agreed to buy Life Storage for $12.4 billion in an all-stock deal. Life Storage operates more than 1,100 self-storage properties. Self-storage real estate benefited during the pandemic because people wanted more space while working from home. But demand and pricing power have begun to soften. Walmart is trying to boost its e-commerce appeal with a new online look. A revamp of Walmart's website website and app was unveiled today. Now, it seeks to highlight a selection of goods and cut down on clutter. The goal is to entice shoppers with items they weren't necessarily looking for, instead of offering a framework for those who already know what they want. And a group of banks led by Goldman Sachs is trying to offload the riskiest chunk of financing from last year's Citrix Systems buyout. The lenders have been stuck with the debt for months. Bloomberg's learned they're now offering $3.8 billion of second lien notes at a coupon of 9%. And that's your Bloomberg Business Flash. Alex.
All right, Lisa, thanks very much. This is breaking news for you. ECB's Robert Holzman saying that a half-point hike is, quote, still on the cards for May, and that the OPEC Plus decision is going to add to inflation on the margin, but then also can't ignore the potential curbs in credit supply. So it's trying to tread the line there, but definitely giving some read-through onto what happened with OPEC Plus and the oil price. Half-point hike is still in the cards for May. You have Italy front-end yields up by about 4 basis points. All right, it is also 23 minutes past 7 on the West Coast, so we want to get to the startup where we cover the top tech stories from the Bay Area and beyond. Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. The news over the weekend, overnight, was Tesla and what they were able to sell in terms of their cars and then in terms of the discount that they offered. Do we read this as good news or bad news?
Both. I mean, the sell side are reading it as concern around demand. So Tesla delivered more than 422,000 vehicles in the first quarter. That's a record for Tesla. It was above expectations, at least from sell side expectations. But it's not enough to keep Tesla on track for 50% annual growth. That 422,000 odd number puts them on track for around 40% growth. And earlier this year, Elon Musk talked about how in the first couple of weeks of 2023, demand was running at twice their ability to produce, largely because of price cuts. But if you take that number and then you look at how production actually was higher than deliveries, in other words, inventory built up in the quarter, there's evidence that demand kind of tapered off in the last 2 weeks or so of the quarter, which is a concern.
More price cuts?
It's certainly a lever that the analysts think is available to them. The concern from the street is that margins are going to be impacted, right, going forward. Profitability is going to be impacted. Elon Musk has been very sanguine about that. He's talked, about the worry of a deep recession coming this year, but he's also talked about Tesla being willing to take a hit to margins and profit to protect growth, to get to that 50% annual compound growth rate. They have a good chunk of cash on the balance sheet to survive it. Again, they did talk about this idea that at the end of the quarter, think about where you are in Europe, Guy, in terms of the Berlin plant, a high number of vehicles, particularly Model S and Model X, were in transit as they try and smooth out the mix of deliveries. In other words, they're shifting production for local markets to those markets, and the logistics aren't quite there yet. Still, how much pain Tesla can take, or more importantly, shareholders can take, will depend on how long a recession lasts, if one comes at all.
To that point, and quickly, what does it mean for their competitors, like a Rivian, for example?
Yeah. So Rivian also came in above expectations for the first quarter, but sequentially dropped production quarter on quarter. That's largely because they had planned to pause Amazon Prime van production. But you can just see production ramps are not straightforward. Rivian shares are lower as well. They beat expectations, but it just shows that all the struggles of 2022, they kind of continue, and that's before you think about demand in Rivian's case.
Great stuff, Ed. Thank you very much indeed. Ed Ludlow joining us from San Francisco. Coming up, we're going to go back, ironically, to the oil story. Amrita Sen is going to join us from Energy Aspects. This is Bloomberg.
about an hour into the U.S. trading session. We got the ISM manufacturing data that definitely disappointed. You now have equities kind of around the highs of the session and yields also falling lower. Abigail's tracking all of these moves for us. Hey, Abigail.
Hey, Alex. And yeah, mixed moves at this point, really having to do with energy. We have that outperformance for energy on the surprise OPEC plus cuts. That has oil popping higher, the energy sector popping higher. So the weight into the S&P 500, even though it's not great there, you can really see it more so with the Dow. The tech-heavy sector is down, although well off the lows, to Alex's point, because earlier, before that ISM number coming in weaker than expected, yields been higher. Now they're lower. That seems to be helping technology come off of its lows. Let's see whether or not those indexes can go higher. Now, speaking of higher, the energy sector up 7 days in a row. This is the longest winning streak in more than a year. And here's today's big pops. Over the last 7 days, up more than 12%, but over today, the course of today, this absolute spike higher on the surprise cut that some analysts are saying could drive oil back above $100 per barrel, the best day for energy. Today, going back to October of last year, and if we take a look at some of the individual movers, it's really pretty incredible. Marathon Oil up 10%, Schlumberger up 9%, ConocoPhillips, a massive oil company, up 10%, and then ExxonMobil, the top point boost for the S&P 500, a rare occurrence, but because it's up 5.7%, that is happening. Now, speaking of the S&P 500, let's check in on one of the wonkier charts that we have not checked in on for some time, but it's actually working really pretty well. So this is the S&P 500's range over the last year, and you can see these moves down and then up. These are basically what are called bull wedges. It represents a culmination of selling. We had been watching this bull wedge for quite some time. It is now performing well. The S&P 500 close to the top of the range, well above the 200-day moving average. The big question now is, are we going to see a break above the range? Now, the recent strength guy, of course, has been on oil, energy being higher. We had some tech strength. To break above that range, I would say that we're probably going to need to be in the energy, or excuse me, the technology sector because of the big weighting. But that's the question. Above the range or back into the range? It's unclear right now.
Mike Wilson saying he sees no sign of a start of a bull market at this point, but we're going to watch that chart very carefully. Abigail, thank you for bringing it to us. Abigail Doolittle on the markets. Let's get back and talk more about that oil element, though. The question of the day, a fairly straightforward one. Are we, as Abigail says, heading back towards $100 a barrel? Let's put that question to Amrita Sen, Director of Research at Energy Aspects. She sees oil at 116 in the second half of the year. Amrita joins us now from Singapore. And Amrita, you're in Singapore, so this question feels kind of even more relevant. Would the Chinese tolerate those high prices?
All I've done in the last, well, at least today and definitely some in the last week as well, has been meeting our Chinese clients here. And they have just been asking about OPEC. What was the rationale? What does it mean for prices? One thing I will say, though, is that demand is recovering in China slowly but surely. And you are the general sense I get over here is also that savings, in our numbers show that Chinese savings are about 10% of GDP. They are actually okay with high prices. Yes, they are concerned about OPEC's policy, but I think that East's ability to withstand high oil prices is much, much greater than the West. Over here, Guy, if you come, there is no recession. Like, there is no R word ever uttered over here. It's how much is China going to grow and for how long? Whereas in Europe and in the US, the first word in any meeting is, oh, how big is the recession going to be?
Yeah, Amrita, I keep hearing that the closer you get to the East, the more bullish you are, basically, is how that's working. We're also going to get some refiners coming back from China at the same time. So when do we get to $100 oil? Does this just push all that forward?
So, look, our price forecast for $100 that Guy mentioned, that's been there even before the OPEC cuts, right? We haven't changed any of that view. Our view has been that second half will be very, very bullish as long as the global economy is okay. How am I defining okay? We have a mild recession baked into our numbers for the OECD in particular. We've got a small recession in the US. We've got a small recession in Europe. And that's why our overall oil demand number isn't that very big. It's about 1.5 million barrels per day of growth. So as long as that happens, we were going to get $100 anyways. Now with these OPEC cuts, that could come earlier in potentially late Q2.
Amrita, why, given what you just said, why is OPEC cutting at this point? If Asia looks strong and that's now its biggest customer, why the need to cut output?
Because at the end of the day, and I have been writing this day in, day out as well, regardless of our view, I cannot be sanguine that there are no more skeletons or further skeletons in the closet. This banking crisis is by no means over. We've had a few banks, and of course this is not 08, 09, right? But I do think, in general, having had 15 years of zero interest rates and suddenly going up to 5%, we are going to see credit tighten up. That was one of the reasons why we have lower demand growth anyways. And we just cannot rule out what that could look like. So OPEC Plus, are correctly being cautious about it, saying, and oil is being impacted by exogenous factors. If you ask me the single biggest reason, I mean, of course, you're putting a floor, you're kind of guaranteeing future investment, but it is very much about driving those shorts out of the market. The market had become a playing field for these shorts because people were like, oh, oil's not going to go up because of X, Y, Z. Definitely a huge amount of short positions. That's what OPEC is trying to get rid of, saying, look, we are still in control of the market. Don't try and drive the price down for non-oil fundamental reasons.
So, Amrita, I love that you mentioned that because it feels a little bit like the Fed. The market pushes the central banker, and I'm putting that in quotes. Like, are the markets just going to keep pushing around OPEC? I hear that that OPEC's like, guys, if you're short, get out. We don't like you. Here's the floor, and it's 80. But the shorts did it. Like, they forced their hand.
They forced their hand, and I think right now with where prices are, I don't think they won, right? I think that's the problem, and I think that's kind of what OPEC is trying to say to them, that sure, you could, you could take us on, but I think at your own peril. And I do think, generally speaking, ever since 2020, cohesion is very good, and I really do think OPEC are very much in control of this market. So I'm not going to, if I was a trader, I wouldn't necessarily take them on. Even in a very, very big recession, I really think, and we've seen this in 2020, OPEC will come cut and provide a floor to prices.
Amrita, just to be clear though, there is no signal in this cut vis-a-vis Chinese growth. This is not a signal from OPEC, who have very close connections from with China, now saying, we actually don't think that Chinese growth is as good as we maybe thought it was.
No, and it's funny you ask me that, right? Funny, like over here, nobody's asking that, but every client of ours in the US is asking us exactly that. Oh, do Saudis know something about the Chinese economy? No. Look, one thing I have learned, and that's kind of been our view, the Chinese recovery is happening, but it is gradual. Mobility is back, but jet, for instance, isn't back because flight capacity isn't back. Property markets are just starting to pick up. Manufacturing is still lagging. This is not going to be a 3 to 6 month boom bust. It's a long 18-month process, just like we've seen in the West. So I think, again, from Saudi's point of view, it's a long game. China is coming back, but it does take time, and the West is weak. So they are taking a holistic picture, and this is very much about those shorts. It has nothing to do with Chinese growth. Trust me. So OPEC Plus know better than anybody what China is doing, and that's why they cut in October when we were all saying, oh, the market looks good. But in fact, China was actually looking very, very poor.
Yeah, Guy and I were discussing this too. It's like there was no macro signal, but there could be a macro impact in sort of what the Saudis wound up doing. Amrita, you mentioned response. Does Shell respond to this?
Shell, no, because again, like we've had higher prices than this, and they couldn't, or they chose not to increase production because the focus has been on just returning money to shareholders. For me, actually, Shell, there's more downside risk to upside risk because of the lending issue, because smaller banks, they are going to struggle to lend, and the privates, the smaller shale players are very, very dependent on these smaller banks. So I actually think there's downside risk to U.S. production, regardless of the price of WTI, because of just tightening credit.
Staying in the States, Amrita, do you think OPEC was a little ticked off that there was an announcement coming from the White House that we weren't going to see a refilling of the SPR? To what extent was that a catalyst as well for today's announcement?
I am sure OPEC are looking at all those factors, right? I don't think that was the biggest driver. But of course, I mean, at the end of the day, the U.S. administration released record volumes of SPR in a year where ultimately we didn't lose Russian volumes. And then when it came to refilling it, they couldn't because, again, they had maintenance and so on and so forth. So if you are looking at long-term investment and you want long-term stability to prices, the U.S. government hasn't provided that despite talking about it, right? It has fallen on OPEC. So I think in some ways OPEC said, fine, this is on us now, and we're going to, manage the market.
Amrita, I mentioned refiners earlier. They're coming back online right after maintenance, and I'm wondering what this does to the refining margins that we're seeing right now. Clearly, we need the product. Refining margins have been really good. Play this one out for us a bit.
We actually think refining margins will start to come off, not just yet, but end of second quarter, really in the second half of the year. Lots of capacity coming on in the East, mainly the Middle East. That will add a lot of diesel capacity, and especially diesel demand is weak. We are in an industrial recession. But we are bullish summer gasoline, and in part it has already made the move. It's not saying that we're going to get much more upside from current levels, but summer gasoline will be strong because consumers are still strong and we don't have enough gasoline capacity. So yeah, margins will still remain good for the next few months, but starting to taper off. Also remember, when crude rallies, margins by definition will come off. So we are expecting softer margins, but nowhere close to like 2019 levels in general, just softer than last year's levels.
Amrita, I want to keep going back to China because you are there, and I'm just curious about it. If the price gets too high, does China switch to other suppliers? What happens with Russian crude? What happens with Iranian crude? I'm wondering where the price point is for that.
Well, to be honest, they have been buying more Russian crude this year anyways. Last year, they didn't buy much because they were not buying much overall. This year, Russian crude to China is about 2 million barrels per day, which is about 20%. And China tends to never buy more than 20% of any commodity from a single country, which is a very interesting fact. Maybe they'll go up a little bit more, but they do care about diversification in their energy security. Now, they could definitely go up more. Iran continues to flow into China, no change. Big change that has been, and we have been flagging this, is Venezuela. Big corruption scandal right now, and therefore China isn't able to attract a lot of Venezuelan barrels, and they are looking for alternatives. Another reason why these OPEC cuts do hurt them, because again, it's a similar type of crude, right? It's medium, heavy, sour crudes.
Right. So also the U.S. can't really replace that. Before I let you go, I just got to ask the nerdy question. What's your base case for actually how much supply will be off the market with OPEC Plus?
Great question. So we think, generally compliance, when these are voluntary cuts historically, they have tended to be good. Not expecting a full 100%, I'm sure, especially if prices tick up, there will be some laggards, but we are still penciling in about 1 million barrels per day of that 1.1 that was announced yesterday.
All right, fair enough. Amrita, thanks a lot. It's like midnight there. Really appreciate you staying up. Thank you so much, Amrita Sen, the Director of Research over at Energy Aspects, joining us from Singapore. All right, coming up, investors are taking WWE stock to the mat after the sports entertainment company announced a $9 billion deal to combine with UFC parent Endeavor. More on the details on the sports media merger next. Stocks off the low. This is Bloomberg.